Hi, everyone. Welcome to episode 3 of the Harry Sale Wealth Show. Today, I'm interviewing Riaan Botha, who is a senior trust advisor at Solus Trust here at Raymond James. He has over 20 years working in the industry on different aspects of wealth planning, on the insurance, tax, estates, and trust sides. But today, what we're really going to focus on is how can Canadians minimize their taxes and pass more of their wealth to future generations as tax efficiently as possible. Riaan will show you a number of different strategies that are available to all Canadians. Have a listen to what Riaan has to say, the step-by-step process on how to get this done. And if this applies to you, I would say take the initiative and contact your financial advisor and see if you can get a ball rolling. Without further ado, I'd like to present my interview with Riaan Botha. All right, everyone, welcome Riaan to the Harry Sale Wealth Show. Let's just get right into it. Why don't you just give us a little bit of a background, how you're involved with Raymond James and Solus Trust, and how you work with financial advisors?
Yes, yeah. So I am the senior trust advisor for Solus Trust. Solus Trust is the trust business for Raymond James, and my primary focus is on assisting Raymond James clients and other clients together with the likes of Harry to then ensure that estate planning is done properly with the guidance and assistance of clients, lawyers, and tax advisors, and then potentially see how we can get into a fiduciary responsibility in assisting clients one day when they pass on and acting as executor.
I just saw an article on CBC about wealth transfer, trillions of dollars in Canada and worldwide are going to be changing hands. So I know a lot of people might say to me, Harry, how can I minimize my estate tax? Number one question I usually get from a prospect and a family, how can I pass money down from generation to generation? So how can you really work to minimize taxes for higher net worth families in Ontario and maybe a bit towards Canada in general?
Okay, yeah. So there's probate planning opportunities and then there's tax reduction opportunities. So when we look at probate fees, the most cost-effective way to minimize probate fees in Ontario is through proper estate planning. Strategies can include transferring assets into a living trust, designating beneficiaries for accounts like RSPs and TFSAs, and holding property jointly with rights of survivorship. Creating multiple wills can also help exclude certain assets from probate, such as shares in private corporations, because remember, in the likes of Ontario, you can have a primary and secondary will. If you cannot reduce or avoid probate fees, a tax-efficient way to pay any estate taxes and probate fees is to use properly structured life insurance to pay the liability. So some of the tax reduction strategies include using life insurance to minimize taxes when passing wealth. So life insurance is one of the most powerful tax minimization strategies in Canada because proceeds are paid out entirely tax-free in the name of the beneficiaries, and life insurance allows funds to be paid out and to bypass the estate, allowing for greater privacy and avoiding probate fees. Second one is gifts of cash to minimize taxes when passing wealth. So gifts of cash made to family members are not subject to any tax nor limits on amounts. So remember, in Canada, there's no gift tax, unlike in, for instance, the US. You can also look at utilizing a family trust to minimize taxes when passing wealth. A family trust would hold the shares in your business and sell them on your passing. As long as the business qualifies as a small business corporation, using the family trust would allow for the multiplication of the lifetime capital gains exemption for each beneficiary of the trust. Fourth one is to look at incorporating potentially a charitable giving strategy in your legacy planning. To encourage charitable giving, the government provides you with a tax credit when you make a personal donation to a registered charity. This tax donation, a tax credit, can be used to reduce your taxes payable. So that's some of the strategies that you can look at.
In terms of keeping assets away from creditors, are there ways that families can separate some of their assets or their inherited wealth in case they are approached from creditors?
So I would say keep your inheritance separate. Try not to commingle inheritances. Setting up a prenuptial or postnuptial agreement is something that we need to look at. Cohabitation agreements for common law couples is a must. And then consider setting up a trust. The trust allows you to control how and when the inheritance is distributed, ensuring that it's kept separate from marital assets. And then most important is documentation and record keeping. So the more proof that you have on what assets belong to whom, it's just easier to make sure that no potential creditor can put their hands on it.
Right. And then as it comes to international assets protection, not only from creditors, but making sure there's a wealth transfer that's as tax efficient as possible. We have a unique situation in Raymond James that we can do cross-border wealth management, but just in general, how would you advise somebody, let's say, who has assets in the United States and might be, a snowbird or somebody with international assets, how you might incorporate those assets into an estate plan?
Yeah, so the best advice I can give is to make sure you have a team of professionals that can lead you through this journey. They need to understand the legal frameworks in the countries where you hold the assets. Potentially look at drafting a cross-border will to cover all your assets, or consider separate wills in each jurisdiction. You can potentially look at setting up trusts to protect assets and minimizing tax implications, or address tax considerations in foreign inheritance laws, and then regularly review and update your estate plan to ensure your wishes are honored across borders, because the world has gotten smaller and people sit with situations where not just assets are international, but beneficiaries, executors are also international. And if you are not properly guided through this process, then you could potentially open up Pandora's box for your beneficiaries.
I know you just touched on it there, but, in terms of updating, how often or when should somebody consider, hey, I need to talk to Riaan, hey, I need to update my wealth plan?
Yeah, so as and when things change during your life, I would say if there's major changes in your family construct or asset composition, then to update your will. Or if there is a change in how you hold assets, you should update it. But preferably at least every 3 to 5 years, consider just looking at your estate plan to see if it's still relevant, and then update accordingly. An estate plan is never cast in stone. It should be something that can be easily adaptable.
And then moving, I know we've talked about the next three parts just in general, but maybe just if you can span on them. So in terms of the best trust options to kind of keep wealth within a family across multiple generations, what are you seeing? What's most common, and what would you recommend for most families?
Yeah, so family trusts are a powerful wealth management tool that allows individuals to preserve assets, minimize tax liabilities, and control the distribution of wealth across multiple generations. Establishing a family trust, individuals can designate trustees to manage and administer assets on behalf of the beneficiaries, ensuring that wealth is protected and distributed according to the predetermined guidelines. Family trusts are flexible, privacy and asset protection benefits, making them an attractive option for high net worth families seeking to safeguard their wealth for future generations. I'm a firm believer in to trust or not to trust. A trust is not something that is suited to everybody, but if properly used for a specific situation, it can definitely benefit wealth preservation across multiple generations.
And just speaking on that in terms of the Canadian versus US, I actually had a client who was saying, we'll put it into trust. It'll be there for a very long time. But I know that there's different rules between Canada and the US. I'm just curious if you can tell the listeners just the difference between what a trust timeline would look like in Canada relative to the United States.
Yeah. So in Canada, there's a 21-year rule applicable to trust. So there's a deemed disposition every 21 years. And in the US, that's not applicable. So in Canada, a trust is a separate entity from a tax perspective, whereas in the US, depending on the type of trust that's being set up, it's handled a bit differently. So that's why, again, going back to having a team of professionals that will be there to be able to guide you accordingly.
So I've heard a lot of people say, hey, I'll just put my money in trust and just stash it away for a long time. So everybody listening, different rules between Canada and the US. It's very important to keep in mind. I know you touched about it earlier, Riaan, about charitable giving. I'm curious about just a bit more detail on how you can incorporate that into an estate plan, really to help maximize the tax benefits and keep as much money within the family as possible.
Yeah. So firstly, you can look at charitable bequests in terms of your will. So you can designate a charity as a beneficiary in your will, either as a fixed amount or a percentage of your estate or a residual beneficiary. So meaning you're receiving what remains after other distributions. This reduces your estate's taxable income, as charitable donations generates a tax credit that can offer you up to 100% of the final year's taxable income, and any unused credits can be carried back to the previous year. Second one is donating publicly traded securities. So donating stocks, mutual funds, or ETFs directly to charity eliminates capital gains tax on the appreciation, and you also receive a tax receipt for the full market value of the securities, maximizing your credit. Third one is looking at donating life insurance. So you can donate an existing new life insurance policy to a charity in two ways. So firstly is naming the charity as the beneficiary, and your estate receives a tax credit when the policy pays out, or transferring the ownership of the policy to the charity, and you receive tax credits for any premiums paid. Fourth one is gifts of RSPs or RIFs. So you can, by naming a charity as direct beneficiary on your RSP or RIF, the donation bypasses probate and your estate receives a tax credit to offset the income tax triggered on these registered accounts. And then the last one is looking at setting up potentially private foundations or donor advised funds. So private foundation is normally if you have significant assets. Setting up a private foundation allows you ongoing charitable giving with the tax benefits similar to direct donations, or a more cost-effective way is looking at a donor advised fund or charitable giving fund, the simpler alternative where you donate to a public foundation such as the Raymond James Canada Foundation that then manages the funds and distributes them over time to the charities of your choice.
I've heard a lot about that, final option there, just being a little bit better on the administrative side for somebody else rather than doing it themselves. Shifting gears maybe to more on the family considerations, aging parents, people who might have special needs or different challenges. I'm curious about how you can incorporate the needs of, long-term care for aging parents into an estate plan, just making sure that it's addressed and there's no surprises for aging parents.
Yeah, so if you're currently taking care of aging parents, it's critical to include this as part of your estate plan to ensure that funds are made available to care for aging parents. That can be the case for aging parents or anybody else. So nowadays, pets are just as important as the kids in the family setup. So making sure that there's cash set aside for the person that's going to be taking care of the pets is also something that you need to look at.
Yeah. Yeah. And then, I know you've mentioned this, but let's just get maybe into a little nitty gritty on tax efficient methods for giving money to children and grandchildren. I know you mentioned there's no gift tax like there would be in the United States, but maybe just a bit of color on if I were a grandparent or a parent and I wanted to make sure that my children or grandchildren had their, education paid for, a down payment paid for, what would you recommend as the top most tax efficient ways to cascade money to future generations?
Yeah. So firstly, as I mentioned earlier, gifting of cash is probably the top one to consider because your gift of cash directly to your children or grandchildren does not have any tax consequences because, again, Canada doesn't have any gift tax, unlike in the US. And to minimize tax, considering gifting cash rather than appreciated assets or transferring assets with little or no capital gains is something that you can look at. Second one is to contribute towards a RESP. That is then, on top of that, you get government grants or tax deferral. Third one is setting up a family trust and looking at income splitting or estate-free benefits. So a family trust allows you to transfer assets to children or grandchildren while controlling distributions. Income earned in the trust can be allocated to lower income family members to reduce overall tax. You just need to keep in mind the potential tax on income splitting as part of that, and then transferring real estate. So reducing probates and future capital gains tax. If you transfer real estate to family member while alive, capital gains tax applies on any appreciation. Instead, consider adding children as joint tenants with right to survivorship so the property passes directly to them without probate, but be cautious. This may expose the property to creditors, divorce claims, or unintended tax consequences. and there is a rebuttable presumption that the assets are held in a resulting trust. I am very skeptical when it comes to adding children or adult children on assets, because if this is purely from a probate planning perspective, it can end up in costing you and the family more. And then the following one is looking at life insurance. Again, it's a tax-free payout and a good estate planning tool. And then the last one is setting up a registered disability savings plan, or RDSP, if you've got any disabled beneficiaries, and you can contribute up to $200,000 to the RDSP. So it's also a good way of looking at the bigger planning opportunity from that perspective.
That perfectly dovetails in my next question, which is how to take care of anybody who has special needs. I know you and I have worked on a Henson Trust for a client. I'm curious if you can shed just a bit more light on the options for anybody who has special needs or qualifies for disability benefits.
Yeah. So if a person is currently receiving disability benefits, it is critical that as part of the estate planning that is taken into consideration. Because remember, if you look at the Ontario disability benefits that you receive, if you inherit more than a certain amount, you can potentially be excluded from further receiving disability benefits. So utilizing a Henson Trust, the Henson Trust was the name of a case that took place in Guelph in the 1980s, whereas it just says that any assets that goes to a beneficiary in an absolute discretionary trust is not taken into consideration as assets for that beneficiary, and that beneficiary can then still receive disability benefits. And then, as said, looking at RDSP to mix it up between how you potentially then provide for the beneficiary.
And just in terms of digital assets, we have like NFTs and things like that, and also dovetailing maybe towards a dual will structure, if you can shed some more light there. I've had a number of people ask me, how do I account for cryptocurrencies or digital assets within my estate plan? Really curious what you've seen over the last little while, as we've obviously evolved into a new realm. But just curious how you would account for those digital assets and what people can do to, have them as part of their estate plan.
Yeah, it's something that's going to increase. The world is becoming a lot more digital. More people are having exposures to cryptocurrencies, NFTs, etc. So starting off with a comprehensive inventory is a definite must. And then looking at secure storage of access of information, but then also having clear instructions to executors on how it should be managed and handled and how to gain access to it. If you go through the process of setting up your estate plan, setting up a letter of wishes or an instruction letter to the executors can contain all the information pertaining to digital assets. It's not just cryptocurrencies. If you look at email accounts, Facebook accounts, so all social media accounts, there is a set way or set ways of how that should be handled after your passing. A good example is if somebody accesses some of your social media or your bank electronically after you've passed on, it might be considered hacking. So giving proper instructions to family and friends on how it should be handled should definitely be included as part of your estate.
Yeah. And sometimes even my dad has a hard time remembering passwords, so maybe it is a good thing to just write it down and keep it centralized somewhere.
Correct. Yeah.
Yeah, I just wanted to move into a bit more of a scenario planning, because a number of clients I speak to from many different backgrounds have asked me specific questions about their scenario. So we'll go through about 5 of those. I'm just really curious about what you would say in these situations. I spoke with a dental prospect. He is a partner in a practice in Toronto. His business is starting to take off. He's finally paid off his student loans and his debt to get into the business. His question really, when he asked me, and now I'm going to ask you, is what steps should he have taken at this point to protect his newfound wealth and minimize his taxes in the future?
Yeah. So again, speak to your lawyer or tax professional. You can look at optimizing the business structure through tax efficiency. So if you haven't already considered incorporating your practice to benefit from the small business tax rate, use a holding company to protect retained earnings from business liabilities and invest surplus funds tax efficiently. Second one is to maximize tax advantaged accounts such as TFSAs, contribute to your RSP. If you're incorporated, an IPP can provide higher retirement savings with tax advantages. And if you've got children, contribute to their RSPs. Look at tax efficient income splitting. So if your spouse or family members are in lower tax brackets, you can pay them a salary for legitimate work in your business, or again, use a family trust to distribute investment income tax efficiently. Then you need to look at protecting your wealth through insurance and asset structuring. So corporate-owned life insurance, protect your wealth while creating tax-free liquidity for your estate. And then critical is looking at disability or critical illness insurance, so ensuring financial stability in the case of unexpected health issues. Unfortunately, globally, critical illnesses are on the rise, and if you haven't made a plan for that, that can potentially pull your business down. So next one is looking at a plan for succession and exit strategy. If you plan to sell or transition your practice, structure your business to benefit from the lifetime capital gains exemption. It is critical as part of the estate planning process that you look at your business succession plan as well. I've had quite a few cases in my career where people are so fixated on building the business and then have separate discussions pertaining to their estate planning, but the two don't talk to each other. And then when that key person passes on, the business goes down the drain and everybody that works for that business is sitting without a job. So making sure that gets done is critical. And then the last one is looking at charitable giving for tax benefits. As I mentioned earlier, you can look at a donor-advised fund or a charitable giving fund to try and eliminate or minimize potential capital gains taxes.
I know there's a number of people who own their businesses out there, and certainly people who want to shield everything from tax as much as possible. So that's very helpful. I received another question from a prospect of mine in Vancouver. Her and her husband said, "We're professionals in Vancouver with high liability careers. How can we shield our personal assets from potential lawsuits while complying with laws in BC?"
So once again, if your profession allows, incorporating your practice can separate personal and business liabilities. Using a holding company for extra protection is something that you can look at, and you can explore in setting up a family trust can benefit you. As part of the family trust structure, if you want to set that up, just always remember the 21-year rule that can come into play as part of this plan. So working with professionals as part of this will provide you with the best guidance on how to handle it.
Perfect. The third question I had was from snowbirds, so people who are aspiring to be them, actually. They said, "We're considering buying a vacation property in the US. How does this complicate our estate planning as Canadian residents, and what specific steps should we take?"
Yeah, so again, my best advice is speak to a cross-border tax and estate planning lawyer before you purchase the property to ascertain what will be the best way to own the property. If you go through the process of buying a property and then trying to fix it afterwards, it can become very costly. So there's various ways on how to best own property, for instance, in some of the states in the US, but proper guidance from your, again, team of professionals is required as part of this.
Perfect. Second last question. As residents of Ontario, how can we set up a trust that gives our children gradual access to funds as they get older? I know we've spoken about this a few times, maybe just a step-by-step. If somebody were to come to somebody like myself or yourself and say, we need a trust, what would the step-by-step process look like for them?
Yeah, so again, you can set up a discretionary family trust, which allows the trustees to decide when and how much to distribute. This can be done through a testamentary trust, so created in terms of your will, or by setting up an inter vivos trust or a living trust during your lifetime. You can then define when and for what purpose funds can be distributed to the beneficiary. So if we split it, the two big options that you've got is either setting up something during your lifetime that will then be guided by the trust agreement. And normally what happens is the person that is the settler is also then one of the trustees, and then most of the time the family or the beneficiaries, and you can dictate and manage those assets for the benefit of the beneficiaries, or potentially look at setting up a testamentary trust in terms of your will. So what in effect happens is you dictate in your will how those assets should be managed, distributed, etc. And then upon your passing, the trustee then manages that in terms of the guidance provided in terms of the will. So it's that whole discussion of the fire hose approach or the faucet approach. So fire hose is, there you go, there's your inheritance and it's yours, and you don't control how it gets distributed or utilized by the beneficiaries. Or the faucet approach is the testamentary trust approach, where you, for instance, state that if a beneficiary is, for instance, under the age of 25, he or she is not entitled to any capital, but it is then distributed over a period. So at the age of 25, let's say 25% of the capital, at the age of 30, another 25%, and at the age of 35, the remainder is then distributed to the beneficiary. So it's a good way of, I'm not going to say dictating from the grave, but providing some guidance from the grave that assets are not squandered. I've been in this industry now for close to 25 years, where I've seen the good, the bad, and the ugly, where an 18 or a 21-year-old inherits a large sum of money and then quickly loses everything. So again, it's just providing that guidance as part of our estate plan.
The last question that I received from a client was, we're thinking about setting up a family foundation as our wealth continues to grow. Can you explain the process and the tax implications for setting up charitable foundations in Canada?
Yeah. So firstly, you need to look at choosing the right type of foundation. So in Canada, as I mentioned earlier, you can set up a private foundation or a donor advised fund or charitable giving fund. So private foundation provides you with full control and more administration. You register as a charitable foundation with the CRA. You control grant-making decisions, but must meet annual reporting and governance requirements. Requires an annual minimum distribution of 5% of the assets to qualified beneficiaries. Whereas a donor-advised fund is lower admin and less control, it's a simpler alternative where you contribute to a donor-advised fund through public foundations such as the Raymond James Creditors Foundation, and you get immediate tax benefits, but do not need to manage the foundation's operation. So some of the tax benefits of a family foundation, again, donations receive a 75% net income tax credit, and then you eliminate capital gains taxes. So donating publicly traded shares directly avoids capital gains tax. So steps of setting up a foundation is you can incorporate the foundation, so register a nonprofit corporation as a federal or provincial corporation, and then appoint at least 3 directors, normally family members or trusted advisors, and then apply to the CRA for charitable status. So you submit an application form to become a registered charity. The foundation is then defined as for its charitable purposes and commit to distributing that 5% annually. You then fund the foundation, develop a giving strategy, and then maintain compliance. So some of the key considerations is, again, private foundations have higher administrative costs and legal and accounting compliances, where donor advised or charitable giving funds are simpler but limit your control over the longer giving decisions. But you can have a letter of wishes that you direct to that donor, to the foundation, on how it should be utilized, and potentially appoint people in terms of your will that should take over that role upon your passing.
And as we move into the Just final thoughts process here, Riaan. I know we've spoken ad nauseum about a number of basic concepts to some of the advanced, more tax-saving options. If you could say one thing to a number of Canadians all at the same time, that would be a number one tip or some biggest piece of advice that you would love to be able to just tell everyone. Why don't you just share that with us now?
So firstly, start by getting an estate plan in place. If we look at the stats in Canada, less than 50% of Canadians have a will in place. If we go to people under the age of 30, that is decreased to less than 30% have a will in place. And if you have a document that dictates and guides on how your assets should be distributed upon your passing, it really avoids potential conflict between family members, and can potentially save you a lot of taxes. And then secondly, have a team of professionals. This is getting more and more complex. And if you want to do a do-it-yourself estate plan, that can be done, but it's not advisable. Make sure you've got a team that is able to support you, especially if you've got complex assets, or if you've got complex family, or you're exposed to various jurisdictions. That can potentially eat up the inheritance, and that was never the intention.
Well, I sincerely appreciate your time and your insights today, Riaan. Thank you very much for joining us.
Thanks, Harry.